Welcome guys, welcome to another episode of Mutual Funds Ki Baat ICICIdirect के साथ. Today we have Mr. S Naren with us. Mr. S Naren is the Executive Director of ICICI Prudential Asset Management Company and he is also the Chief Investment Officer at this company. He is associated with ICICI Pru since 2004 and holds almost 2 decades of experience in this industry. It's an absolute pleasure to host you, Mr. Naren. Before we get into the actual investing journey and investing talks, we would want to know a bit about you. So could you just explain and tell our viewers about your journey, and did you always wanted to be in this field?
Yeah, actually, I wanted to be in this field. And even while at IIM, I was very keen on being a fund manager. And after IIM, actually, I ended up being a stockbroker for quite some time. And I got a chance to come to Bombay. And somehow in the year 2004, I got a chance to be a fund manager. It was something which I thought I would not be able to make it. But I got a chance in the year 2004 at the age of 38 to become a fund manager. So it was very interesting that I got that chance in the year 2004. But throughout my life, it was my interest to become a fund manager.
So basically, you're working what you always wanted to do.
Absolutely.
So you joined this company in 2004, and we are in 2023 right now. So what is the major difference you're seeing investing then and investing now?
The complete, the scale of operations of ICICI Prudential then, we used to have about 2,000 crores in equity assets and less than 8,000 crores at that point of time. Whereas now we have 5,50,000 crores in assets and more. So you can see what the scale of the company has increased. Over this entire period, the regulator has continuously worked to improving regulations, which has helped in scaling up the assets over the period.
Yeah.
And the entire equity market has actually constantly grown, that we've been in a position to manage large sums of money. And India has also been a phenomenal growth story from 2004 to 2023. So I think we've been at a right confluence of growth in every way. And that has helped us in a big way at ICICI Prudential.
Right. So, Mr. Naren, there is one thing about you that people say that you are someone who has a contrarian view and someone who looks for value. So, this is your investment philosophy right now that you're known in the market. So, is this has been your philosophy since you entered this field, or it has evolved over time?
So somewhere in the 94-95 bull market, this was much before I joined the firm, I had a lot of setbacks. And in that setbacks, when I went back and introspected, I found there was a lot of momentum thinking that I had applied. And then I found that many of my friends had also applied momentum thinking. And whoever had applied momentum thinking had suffered huge losses. So we went back and said that what can we do to prevent that from happening? And we realized that a contrarian value approach helped. And in the late 90s, the only investment books that were available were investment books that were written on Warren Buffett. So the combination steered us into value investing. And so over a period of time, we started looking at contrarian and value-oriented strategies. And over this entire period, later, I got a chance to be involved in the Value Discovery Fund. And it stuck on. And the period from 2007 to 9, when we went back and looked at it, we found that value was a very, very interesting strategy. And it stuck on. And we found over the period, it's a very, very interesting way to manage large sums of money for other people in the long run.
All right. So, any contrarian sector or something that you're looking out for right now for investment?
I think over the next 1 year, it could be in IT, not necessarily today, but over the next 1 year, it certainly IT is one of the sectors which is doing very badly and where the outlook looks to be pretty bad in the near term. So I think that's a sector which certainly one can consider to look at as the results come bad. And let's say US does go through a recession over the next 1 year. I think it will be one of the sectors to look at.
Yeah. So my actual question was something on the IT sector only. So right now we are seeing IT sector corrected a lot in the last 1.5, 2 years. and right now Nasdaq is hitting new 52-week high as we speak. So would you invest in Indian? Would you find value in the Indian tech company or the US tech company if you want to look at?
So actually, what has happened there is that in US tech companies, you have to look at it. It has been captured by the imagination of artificial intelligence. So it is just a few set of stocks like Nvidia and all that, which has actually shot up through the roof. Whereas India is an IT services hub.
Yeah.
So if you look at it, it is IT services hasn't gone up. It is actually anything to do with AI and generative AI, which has gone up. So I don't think both are linked in any way. And I think Indian IT services would be the sector which may become a contrarian buy at some point of time.
All right. My next question would be on the new age companies. So there were a lot of companies got listed last year, and they corrected heavily post their IPO. Are you finding value in these new age companies as we move ahead?
Certainly, in between, some of the new age companies saw a lot of capitulation by the holders, and we used that opportunity. Otherwise, when the new age companies were getting listed, I used to tell them that I was too old to understand them. And I got many of my younger colleagues to look at them, and we didn't actually participate properly. But when the capitulation by the existing investors happened, we actually looked at some of them and found them to be more interesting for investment. So I think some of them did turn out to be good investments in between. See, we have to be always conscious of how to look at them because many of them are actually very interesting stocks and very interesting sectors. But the way we need to invest in them is different from the way we look at mature businesses.
Right.
So we have to look at it with a different lens, look at it and see which one to look at and how to value them. It's very interesting.
Right. And you rely on your junior fund managers.
I actually look at some of my younger colleagues because they are much better to look at this because, we are always used to looking at stocks in a particular way. And they are actually users of some of these products much, much more than I do. Yeah. And I found that to be very useful in my analysis of these companies.
All right. Got it. Mr. Naren, there's one interview which I saw of yours where you're saying that India is in a great shape right now, and the Indian macros have picked up really well. So, can you just list down top 3 things of Indian macros that excites you the most?
See, if you look at it, current account deficit last year was not expanding. But if you look at the way services export has been booming, the current account deficit problem has completely gone away. If you look at inflation, in my 34 years of working, it's been very rare that the inflation differential between India and US is so low, and the interest rate differential between India and US is so low.
Yes.
So you have a situation where the growth also, if you look at it, growth, India has always been good, but India is possibly one of the fastest growing countries in the world. And, if you look at the non-performing loans in the banking system, again, it is at a record low at this point of time. Yes. So you have demographics which are great. You have multiple reasons to believe that India has one of the best macro in the next decade compared to most countries in the world at this point of time. And that is the way I can see at this point of time. It's rare to find a country of the scale of India with the macro that India has.
Absolutely. You were talking about the NPA thing because recently the Financial Stability Report also suggested that the NPA is at decadal low. So if I would ask you, would you place your bets on the PSU banks or would you place your bets on the private bank going into the banking sector ahead?
So we will look at each of the stocks independently, and we believe that we have to do bottom-up analysis at this point of time. Because if you look at last year, the net interest margin of the banking system was at a record high.
Yes.
And therefore, credit growth was also at a record high. We don't think that the credit growth and the net interest margin, which we saw last year, is going to get repeated this year. So it requires for much better analysis this year because in some of the parameters last year was phenomenal.
Absolutely.
And is unlikely to be repeated. So therefore we have to do much better bottom-up work. But at the same time, the sector is one of the sectors which is not done as well as some of the other sectors. You're getting opportunities to look at them.
Absolutely. There's one question about you that a statement that you had made is investing is about buying, sizing and selling. But the irony is 98% of the people only focus on buying, and 2% focus on sizing and selling. So could you please elaborate a bit on it?
This is a problem, when I go back to my investing career personally, in way back, we used to create what I call a zoo. And even today, when I look at many investors whom I meet, many of them create zoo, which means that they invest in far too many mutual funds, schemes, far too many stocks. Then you're not going to get a good experience. Frankly, you'll get a very average experience. So, if you want to make money, you have to size some of your investments meaningfully. And once you size some of your investments meaningfully, only you're going to get the benefit of concentration. Even a guru like Warren Buffett says that you have to size some of the investments very well for you to make money. And this is something which people forget. Everyone calls someone and says, I like this, and then they buy some small quantity. What's the point? You have to size investments. And which book tells you that you have to put 80% of your investment in one stock? Rarely. People keep scaring people who do that. But if you want to make money, you have to have a concentrated portfolio. If you're going to have a very widely diversified portfolio, I think it's better you are in an index fund. And I believe that even as a fund manager, there are a lot of people who over diversify portfolios. I believe it's very important that at least at the top you should have stocks which you believe in, which are concentrated. The second is the selling decision. A lot of people forget to sell,
Right.
and then they get too attached to the stocks that they own. And it is true, there are people who say you should never sell. And but at the same time, there are stocks that need to be sold. Suppose you are having a metal stock.
Yes.
At some point of time, you have to sell.
Yes.
And some of the stocks, if you don't sell, they may fall. So, there are people who forget to sell. So finally, some point of time, you have to say, I'm going to sell this stock and buy some other stock. I call it a switching decision. And it's very important that people take a switching decision. And if you don't take an appropriate switching decision, that moderates your return. And how many books have you seen which tells you how to take an appropriate switching decision? So I think these two are the biggest challenges I've seen. And, bulk of the time that, we spend at ICICI Prudential is how do you size these positions? And both sizing position and switching position decisions are both art. It's not easy for most people to take these decisions. And it's not that there's one answer for all these things, but at least you make an attempt at both sizing and switching, you are actually in better shape than someone who doesn't spend time at taking these decisions.
Absolutely. So I'm just getting you back on the same question. Like someone of our viewers who's looking at, like, who's watching this, what should be the ideal allocation for somebody from a retail investor's perspective?
There is no one size fit, for all these questions. It's also a function of the market. So if the market was very cheap and the person did not need money from equity, then then you can actually take a big concentrated position. If the market is very costly and the person needs money at any point of time, much better to have a diversified portfolio. There's no single answer for many of these questions. And so for some of these questions, it's better to consult a wealth manager or a broker to answer some of these questions. There's no one size answer which I can give an audience like what you're asking me. So even, for example, we run funds. So we have a focused equity fund where there are only 30 stocks. In that fund, obviously, we are not going to have too many stocks where the weightage is low. So whereas if I have run a large fund, I would have a big tail, which looks like a zoo, like what I mentioned, because as the stock comes down, I will use that tail to slowly increase the weightage in that stocks. So different funds in my portfolio would itself have different sizing strategies.
Okay.
The same individual would itself have different sizing strategies based on the fund.
Absolutely. So it depends on the individual himself rather than a common answer for everybody. So since the COVID, like post 2020, we have seen a lot of retail participation happening. There's a difference between pre-COVID and post-COVID right now, and a lot of retail investors have started doing SIPs, and we have seen the average ticket size for SIP has also gone down. So how do you see this and the impact on the Indian markets as a whole?
No, I think last year how the mutual fund investor handled the market was just amazing. In my 33 years of seeing market and my last 19 years of in the mutual fund industry, I never expected the mutual fund investor to be so mature that in a big downtick they increase their allocation to equity, and that was just amazing. And I think the entire mutual fund industry sales force and the mutual fund industry investor deserves a big clap, because as an investor and with my behavioral finance thinking, I actually thought many of them will say, no, 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 market is falling, let's stop investing.
Absolutely.
Instead, the reverse invest happened. So I think it is just amazing. And I mean, I think the maturity of the mutual fund investor has been awesome, if you ask me. Having said that, I think it is important to recognize that equities carry their own risks, and investors should be conscious that in the last 10 years, equity markets have never seen a meaningful correction in India. That does not mean that equity market doesn't carry risks.
Yeah.
And this is something that investors should know that. And that has happened only in India. Even in a market like NASDAQ, there has been a period of time where the 1 year return has been more negative than in India.
That's right. That's right. There's one more thing on the SIP of the retail investor. The data suggests that anyone who's buying a fund holds it only for an average of 2 to 2.5 years. So if somebody is investing in SIP, what would be your suggestion for the holding period? One should, because selling, as we discussed about selling, you need to sell your portfolio, some holdings in your portfolio. For the SIP investor, is there any advice that you have?
So I'm a believer that markets have 5 phases. I call one is a bust phase, then boring phase, best phase, bubble phase, and boom phase. And once in 10 years, you have a bubble.
Right.
So if you go back and see, there was a bubble in 1992, there was a bubble in 2000, there was a bubble in 2007. So in a bubble phase, I would actually recommend people to take out their SIP, accumulated SIP. In all other phases, I would tell them they should just continue with their SIP. In all phases, you continue with your SIP. But in a bubble phase, take out money from the SIP.
Absolutely.
That's what I would recommend.
Absolutely. That's a great suggestion for somebody, because bubble is the main part where people are.
So once you see newspaper articles saying this is a bubble, that I think is the time when they should consider taking out accumulated SIPs without closing the SIP.
Absolutely. Sir, we had a lot of discussion around the markets. So, but let's move on to your hobbies. What do you do outside the markets when you're not looking at the markets, studying financials of the companies and all this stuff?
You know, in my study period, I was addicted to bridge. So of late, I've been playing computer bridge, which is so easy to play, and I cap out. I don't play too much, so I'm not addicted to it. My son has a genetic disorder called Fragile X, so I spend some time understanding about it and see what can be done about it. And my job keeps me busy all the time, actually.
Okay. Any books that you can recommend to our viewers that they can?
So I think, I have been shaped by 3 people. One is a person called James Montiel, who has written a book on behavioral finance. It's a small book. Then there's a person called Michael Mauboussin, who has written a beautiful book called More Than You Know. There's a person called Howard Marks, who has written 2 books. One is on cycles and another is on investing. And all his writings are available on oaktreecapital.com.
Okay.
There's a nice book written by Gautam Baid on compounding.
Joy of
Compounding. All these things have been very good learning. But I can tell you from my learnings as a fund manager for the last 19 years, theory is easy. The theory is so well written. If you go scroll the web, you will get 10 tenets of investing by James Montiel. If you read that 10 pages, you will get whatever you wanted to know about investing. Then if you wanted to know what it takes to be a good fund manager, there's again from the web, you can download a talk given by a person called Mark Sellers. But theory is very easy, practice is very difficult. If the practice of a fund manager, and believe me, it is not knowledge, it is not intelligence, it is a behavioral temperament required to handle the market, that in March 2020, to gather the guts to buy big stuff. And that is the challenge which is required. You can read all these things, But finally, the ability to buy in March 2020, to buy post Lemon, to buy post World Trade Center bombing, these are the things which are difficult. And to not get caught in the infra boom, in the Arshad Mehta boom, in the Ketan Parekh boom is very difficult. Frankly, theory is not difficult. Practice is much more difficult than theory.
That's absolutely right, because bookish knowledge and having an experience in the market are two different things
Yeah.
completely.
Yeah.
And to have a skin in the game is more important than knowing the theory. So it was an absolute pleasure, Mr. Naren. Thank you so much for being a part of this series with ICICI Direct.
Thank you. Thank you very much. My pleasure. Wish all the viewers very happy investing. And investing is a great thing, but do it well, do it responsibly, do it with a process, and don't be greedy. In the long run, you will make money by not being greedy and being long term. Thank you.
Absolutely. Thank you so much.
Please note, mutual fund investments are subject to market risk. Read all scheme related documents carefully.